Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And today we're talking about the whole spectrum of investment management approaches, from active to passive management and everything in between. And I think as investors, we often feel as though we sort of face that decision where we have to choose one or the other. But, what if we told you that these approaches are not mutually exclusive, that they can actually work quite well together? So today we're going to talk about just that. We're going to look at some strategies that you could use to blend these two approaches and dig into the pros and cons of each in a balanced discussion. Before we get started, a quick reminder today that we're not providing investment advice or recommendations. Today is all about information and education around investing for Canadian do-it-yourself investors. Today, I have the pleasure of being joined by Sadiq Adatia, our Chief Investment Officer here at BMO GAM. His first time on the channel, I can't believe it. He is responsible for our overall investment strategy and risk management across all of our investment solutions. And I'm also joined today by Chris Heakes, no stranger to the channel. He's the Director and Portfolio Manager on our BMO ETF team, where he focuses on factor-based equity ETFs and derivative overlay portfolios. So welcome back to the channel, Chris, and welcome to the channel, Sadiq.
Thank you.
Great to be back,
you guys.
Thanks.
Let's kick it off. I think we need to level set and start with a review in terms of what is active management, what is passive management, and where and when do we think that it adds value? So Chris, I'm going to turn the table to you first. Take us through passive management.
Yeah, for sure. So, this is really where the ETF industry came from. A fun fact, I don't know if we discussed on the channel, but the first ETF in the world was created in Canada, and it tracked at the time the TIPS 35, I believe. So 35 kind of largest companies on the TSX. The US followed 1 year later with their first ETF, which tracked the S&P 500. So that's really where ETF investing came from. What is passive investing? It's index-based investing, and what these indexes, broad beta indexes are trying to accomplish is really like a representative slice of the market, and not necessarily making a judgment on each company, but saying, okay, what's the size, the market capitalization of each company, and then that will be the corresponding weight in the index. So the aim is to represent the overall equity market of the region in consideration. So we don't do TSX 35 anymore, but think of the TSX capped composite, the S&P 500, MSCI EFI for international stocks, or MSCI, emerging markets. And that's really, when we think about passive, those are kind of core solutions, core building blocks that are used by passive and active investors alike. In terms of the value add of passive, one value add is you're always capturing that winner. So, I started in ETFs in 2011. I believe the top stock in the S&P 500 was Exxon Mobil, or just over 2% weight. Well, we've seen all these tech companies come along, and Apple, Microsoft, NVIDIA now at a much higher representation in the index. So being invested in the index means you participate in that. But, I'm sure as we go through, we'll also talk, with everything that's good, sometimes there's something, there's some risks under the cover as well. So we'll get into that as well. But, that's really where passive investing came from and how it's used in ETFs.
Perfect. And Sadiq, what about the active side?
Yeah, well, in the active side, it's really about fundamental research, right? So think about, understanding who are the management behind every company, how good are they at steering the ship of that company, growing it, being aware of risks and competition. But you're looking at things like revenue, expenses, mergers and acquisitions get involved in that, the valuation of the company. We can tell when a company's good or bad, but do we know if the price is sufficient for what it's currently delivering on. Good example, and Chris touched on NVIDIA as a good example. The hype on NVIDIA is a good one where, today's earnings might be X, but it's the future earnings is what you're paying for. And, if you went back 2 or 3 years ago, you wouldn't have seen this sort of revenue projection because the AI story wasn't as big as an example. So that's how you uncover these great sort of companies that's potential is still not priced into the stock. And at the other end, you get other stories where the best is behind them and the stock is overvalued because the future does not look as bright because things have changed dynamically, right? Whether that's innovation or new entrants into the marketplace. And so you have to be cognizant of that as well. So it's not only pure value added in terms of driving up the stock price, but also protecting the portfolio from risk that might be coming into the marketplace as well. So it's that combination of management, revenues, expenses, obviously looking at the share price to make sure whether it's justifying that, and even market sentiment has an impact, on what companies do, and that is tied to a bit of the fundamental, whether companies are higher beta or lower beta compared to the index names that you might see in the marketplace at their weight as well. So that combination of that is where you can add value.
Awesome. And are there certain market conditions that might be better for either approach? Let's take a look at maybe a market correction type environment, just to pick one. Chris, how would passive perform in that? And then Sadiq on the active side as well.
Yeah, I think passive is usually, it's often the benchmark that active managers will, assess their performance against. But for investors, as we all know, equity drawdowns can be sharp. They can be painful. They can be very much test the investor psychology. Even a couple of days ago, we were seeing some pretty big volatility in the U.S. market, and we know, there's that temptation to sell. So, if you think about corrections, during the COVID most recent correction, the TSX, the S&P 500 were both down around 30%. From a market perspective, at least thankfully, that was recovered fairly quickly. But, if you go back to 2008, kind of around when I started with BMO, and, broad markets were down 50%, the S&P 500 even a little bit more than that. So you can have significant drawdowns on index investing. And so that's something that, again, you earn a return for taking on that risk as an equity investor. But it's something to definitely be aware of your risk, not just in the good times, but in the bad times as well. And really trying to, master that psychology element of it, of probably not selling when things go down is as Buffett said, is a great quote. Be greedy when others are fearful, and fearful when others are greedy. So, something to keep in mind. But, maybe as you discuss active, kind of professional traders can, have a little bit handle on their own psychology and try and make those smart decisions in times of stress.
Yeah, and I'll add to that for the active side for sure. I mean, this is where you're definitely looking at the dynamics of the underlying economic conditions that are out there, right? Some stocks do well when everything looks really great out there, and some do better in more difficult markets. Market capitalization is an important part to that as well, and balance sheets are very important to look at in those environments. So definitely in down markets, when you have portfolios that are maybe more value oriented or more defensively oriented, they should do better than the broad market in those environments. But then at the same time, there are some growth-oriented companies and portfolios that won't do as well because they're tied to a stronger economy. And normally when you have those market crashes or pullbacks, it's opposite. It's when the economy is not as strong or the consumer is not as strong, and you have definitely more difficult market environments. So it does depend, but traditionally you would expect them to be able to avoid the big underperformers that are not doing as well.
I think another kind of consideration, another consideration, Aaron, I think is the index itself. So, if you look at passive investing, it's not necessarily a one size fits all. You look at Canada as traditionally more of a cyclical commodity based, exposure. And, as you and the listeners know, that can carry a little higher risk profile as well. And we can talk more about it as we get through, but, S&P 500, It's been a terrific exposure, to be sure, and it looks like that'll be the case going forward. But there are some risks under the hood. And then in terms of the S&P, obviously it's a very tech heavy index at this point. So it's maybe not a one size fits all, and you can look at each market, and then maybe on the other spectrum you have emerging markets, and you have a whole new set of risks there in terms of governance of the countries and the companies and so on. So not to be the not to be overly kind of talking about risk, but something you can consider when you think, okay, what's my potential downside.
Absolutely. And the conversation today, I want to bring it back to the mixing of active and passive together, and how and why we would want to do that. So Sadiq, maybe you can walk us through that in a bit more detail.
Yeah, for sure. I mean, if I think about multi-asset portfolios as a good example of stuff where you have all these different asset classes, different regions, different capitalizations, right? And not all of them are always best served by being active or passive. And sometimes you need a combination of those. And so when you think about putting a portfolio together, a well-diversified one, you should have that combination of that. I'll give you an example. Emerging markets that Chris was just alluding to, traditionally you want to be a little more active in those areas, right? Because there are things that are interesting to look at there, whether it's political regimes that are there, the impact of that particular currency. And then, of course, there are companies there that, those areas sometimes corruption occurs. And so you have to be very careful about what you want to own. When you look at other markets that are a bit more broad, like the S&P 500, we see that traditionally be very difficult to beat actively, right? But again, if you want to beat actively, you have to be a lot more different than the market traditionally. And so you've got to pick your spots of where active and passive should be in your portfolio. But a combination of both generally gives you a better return than just one or the other. And it also helps on the cost side because you want to spend your money where you can actually add value actively. And when you can't do it consistently, that's when you want to be more passive and save that cost along the way. Derivatives is another thing that can add to your portfolio from an active perspective. Or if you own a passive, you can sell calls and buy puts to protect it from that perspective as well. And then there's other areas where I think where you're looking at more emerging names. This is sometimes where they don't get into the index as an example because they're not the right size or the right liquidity quite yet. But these are companies that might be companies of the future, that might be the leading generation in a particular space, whether it could be technology, social media, or anything else along the way. And the only way you can find those is by having active management, looking at it when they were pre-IPO stages and understanding from that perspective as well. So, when you look through it, you do want to have a combination of active and passive. And it does depend on the economic conditions that are out there as well at times. And again, it does depend on, equities versus bonds as well.
Chris, turning it back to you, anything to add to that?
No, definitely well said. But, the thing that always, pops in my mind is, diversification. And I do like the saying, it's a bit cheesy, but diversification being the only free lunch in investing. And, thinking about diversification, it happens on and can and should probably happen on many different levels. You've got equities, bonds, alternatives to diversify. There's diversifying within regions, maybe some factor or style diversification, but really strategy diversification. We don't necessarily talk about that a lot, but strategy diversification, and that's going to end up, what are your underlying stock exposures? In this case, in the different markets, that's another source of diversification. So, maybe just circling back to the S&P 500 as an example, this is an index where, investors are a little bit more worried about concentration right now and a heavier tech exposure. Maybe if you have an active manager who's got a little more of a quality overlay, maybe a little less of the high flying growth, maybe a little more, higher quality or better value metrics or whatever the case may be, there's different ways to go about it, but you can diversify against the index itself. So I think, that's the real win for investors is, building a more robust portfolio and improving the diversification and to Sadiq's point, the long-term performance of that overall portfolio.
And just add one small comment to that. When we do say active and passive makes sense, it really is if you are truly going to be a good active manager. I think that's the underlying part of it, because there are a lot of closet indexers who call themselves active, but really to have active shares where I think then it actually adds value.
I think the introduction of ETFs has just only raised the bar on active management. It's only been a good thing from that sense as well. So I do want to talk about a couple of the, things that people point out about both active and passive as a potential con. So let's talk about fees first, Sadiq. Many investors have the sense that active management equals higher fees. What would you say to these investors?
Yeah, I mean, they are higher fees, and I think they're justified when you can actually add value. And this is where I think it's so important to make sure that you're paying for the value that you're getting. And when you look at certain markets, they're a bit more expensive than pure passive. But I think the key there is, you're going to get, hopefully, with the right PMs that are managing that, value added over the long term, better risk protection along the way. And just as importantly is that, with all the stuff that's been going on with the ETF world, it's actually driving down the active fees, which I think is great because I think it's better for every investor out there across the board. But the key also, I think, is that you just have to continuously drive that value added and be measuring up PMs against that. I used to make this joke, and I know, I don't know if Chris will like it or not, but I think of active management as a roller coaster ride, but you actually have seatbelts. Whereas when you're in passive, right, because you don't actually have selection of names, you're riding the same roller coaster, right, but without the seatbelts. So that's why I said it is important. So what you're paying for is that seatbelt, that protection, so that you can stay that course of that ride and earn the value from A to B.
Okay. And Chris, I think that's one of the considerations we've heard a lot this year in terms of ETFs is that concentration risk is a factor many investors worry about when index investing. And it definitely came to light this year with the S&P 500 and the Mag 7. Talk to us a bit about that and how it can be managed when it comes to passive investing.
Yeah, so again, I think this is a little bit one of the hidden risks of indexing, and something to be aware of. I'll go back to my example. 13 years ago, we had Exxon was around 2%. There's a few other names. That concentration, is probably up about twofold or threefold. In the last 13 years, it's kind of funny because in Canada, we're kind of used to concentration. I feel like, like the big banks have often been in this kind of upper single digit weight in the index, but certainly new in the US. One interesting kind of thing I've called the curse of Royal. I don't know if this is a widely known thing, curse of Royal, but this has happened in index. There's been 3 times that I'm aware of that a stock has had a higher weight than Royal, and the 3 are Nortel, BlackBerry, and Shopify. Now, Nortel actually got to 35% weight in the TSX index. That's the reason why we now invest in the capped composite, which caps the max weight at 10%. But we know what happened to Nortel. We know what happened to BlackBerry. Shopify, maybe we're doing a little bit better on Shopify right here. I guess time will tell. But certainly, as a company takes on a large weight in the index, and 35% Nortel would qualify as that, you're taking on increased risk. So again, it's, like what's the antidote? What's the answer to that? It's not necessarily a bad thing. The indexes do have a good track record. They sort themselves over time. Nature sorts out, kind of the winners and then the losers, and things evolve, and participating in that index, can be a good strategy. But, again, it's awareness and diversification, really, just to come back to that. And, how can you build a better portfolio? And, I think you could probably look at the US market now and say, well, maybe I want something more than just the S&P 500. S&P 500 is great, but maybe there's some other ways I can look at it to build a better overall, exposure for that region.
All right. And I think recently investors have started to really see that traditional asset classes become very correlated in times of severe market downturns. And that was really proven, in the last one we went through. But talk to us a bit about how investors can protect themselves during these type of events and what other asset classes or strategies might be available to them. Sadiq, I'll start with you.
Yeah, I will say that things like alternatives and privates in particular are going to be a little bit less correlated in that environment than your traditional equities and bonds because they're all traded in a similar fashion. And again, I think this is where it's important to back to Chris's point at the beginning about diversification, right? It's not just diversification between equities and bonds, but also between public and private markets, from traditional to non-traditional asset classes, including derivatives, currency, all these other things come into play. And so that's what you have to look at. We have seen, unfortunately, over the last few years, equities and bonds looking highly more correlated and not giving the offsets that they have traditionally given. Hopefully that's starting to change a little bit back again, but it is things like, REITs and infrastructure as a good example. I'll give you just, the last couple of days as a good example. They actually held up really, really well, right? Despite equities being down on the other end of it. So these are the type of things that are going to help give a better upside and downside capture ratios in the long term if you have them inside your portfolios.
Chris, anything to add there with your background in derivatives?
Yeah, I'd say it's improving the overall robustness of a portfolio has definitely been a key area when we, in recent launches we've done, at BMO, we've launched, within the last year, we've launched buffer ETFs that use options to purchase some downside insurance, sell away a portion of the upside. Obviously very topical now and becoming more topical as things evolve. We launched gold and long short equities. And, so different things that you can put under the hood. I am not an advocate that the 60-40 is dead, but the 60-40 portfolio can be improved. And, having some real asset exposures like a gold bullion ETF, can improve the risk and return of a portfolio. Long shorts have also been navigating these more volatile, last few days, last month or so, very, very well as well. And then the buffers, of course, are purchasing outright downside equity insurance. So, we've actually been focusing a lot on this because, we definitely want to have the best tools out there that can help, reinforce a portfolio and, really make it more robust overall.
I think that's a great point that just was mentioned there. What we've been doing right at BMO has been finding all the pieces that can potentially be used in portfolios at any given point in time to give it a better payoff, from a risk-adjusted return perspective. So the things that, you just heard Chris mention are definitely there. The derivatives obviously are definitely there as well. But using the whole tool set to help us get a better outcome, that's going to give our clients a better result as well.
And it's been interesting to see the increased interest in active-based ETFs over the years as well. I think that's something traditionally people always thought ETFs were passive, but there are a growing number of active ETFs available out there, and they're definitely growing in popularity as well. Thanks, Chris and Sadiq. I think that was great perspective around active and passive, and really how it's not either or, how these two approaches can be very effective when used together. And at BMO GAM, of course, we have a host of solutions that can fit all of your needs. I'd love to hear from our audience in the comments below. Are you using active or passive approaches or leaning towards one or the other in your style? Comment below and let us know. We'd love to hear from you. Thanks again, Sadiq and Chris. I appreciate it. Next week on Market Insights, I'll be joined by Beverly Wilkes. She's the founder of the blog baconandheels.com. She's a financial literacy coach and an advocate of cyber safety. So Beverly's going to be discussing important steps we can take to keep our investments cyber safe and an overview of different strategies we can use to protect our investments from that perspective. So thanks for joining us today. We'll see you next week. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.